What's up, everybody? Dan again, stocktrades.ca. Welcome back to the Stock Trades YouTube channel. Again, we're going to be ramping up the content in 2022, bringing you more great videos to the channel. First off, I just want to apologize for the random backdrop here. I actually ended up moving out of one of my properties and back into a rental property I used to own. So I'm kind of having a mix match office right now while we try to get settled. So in this video today, people have been wondering, they've been asking us a lot, what is happening with tech? What is happening with my tech stocks? Should I still be owning them today? What will rising interest rates do to these stocks? And have I bought into a peak that essentially will never return? And in this video, I'm going to go over some very core concepts that you need to understand as a DIY investor, including why interest rates actually impact stocks the way they do. A lot of people know that interest rates rising are poor for stocks, but they really don't understand why. And in this video, I'm going to try to explain it in the easiest terms possible using two key concepts, and that is the weighted average cost of capital and how the current interest rates impact the discount rate in a discounted cash flow analysis example, which is what many institutional investors, analysts, and retail investors are using to judge whether or not the price they're paying today for a company is worth it. So with that being said, let's jump right into this video and get started now. Tech stocks. If you started investing in 2020 or even in 2021, it is highly likely that you went heavy on tech. Interest rates were at all-time lows. These companies were excelling. They were pushing out outstanding earnings. And realistically, there's a big possibility that you just weren't really ready in terms of the knowledge it takes to build a completely diverse portfolio. So you might be sitting right now a little heavy on tech, wondering if you're ever going to recover. Now, I can't exactly say that because I don't know what you own, but the number one thing you need to understand is why exactly the environment right now is bearish for tech, and why institutions are selling these companies off, and why analysts are downgrading their price targets despite earnings still being quite strong. So the reasonings for this actually come from the most basic fundamentals of investing, and that is you are investing money now for the hopes of a cash flow payment in the future. Whether this be a high-flying tech stock or a regulated utility like Fortis, which we'll get to in a bit how that truly does differ, especially in this environment. But the end result is the money you put down today has to be worth that cash flow in the future. And if you've never heard of the time value of money, this is essentially a core concept that tells you that $1 today is worth more than $1 in the future. So $1 today is worth more than $1 10 years from now, particularly because you have that $1 today and you can invest it and begin earning interest on that money. Now, we know that $1 in the future is worth less than $1 today because of the fact we can invest that dollar today. But how exactly does this help us with investing? Well, in discounted cash flow analysis, we can utilize that dollar 10 years from now and discount it back to the present time to figure out how much we really should pay for that investment. And primarily, you will see two key tools utilized in discounting cash flows back to the present value. And bear with me a bit, everybody. These two numbers are going to be where interest rates come into play. And those are the weighted average cost of capital and the risk-free rate. Both are essentially interchangeable formulas used in discounted cash flow analysis to figure out if a project is going to be profitable for a company or if an investment is going to be profitable for a retail investor or an institutional investor or whoever else is running their models and these DCF calculations. So we'll get started first with the weighted average cost of capital, and I'm not going to bore you in this video and show you how to calculate it. In fact, you can most often find this inside of a quarterly or annual report from the company themselves. But essentially, the weighted average cost of capital takes the three things in terms of debt that a company can take on, whether it be equity in the form of common shares, debt in the form of bonds, or even preferred shares. It takes these three things and spits out a weighted average cost of capital that overall represents the company's total percentage when it comes to borrowing. So how exactly do interest rates impact the weighted average cost of capital? Well, if we go into the formula here, we can see that it is the cost of equity times that portion of equity, the cost of debt times that portion of debt, and the cost of preferred stock times that portion of preferred stock. So if we think of debt, we think of bonds. When interest rates rise, bond rates typically go up. So this is going to be a portion of this formula that is going to be impacted by rising interest rates. And when interest rates go up, the weighted average cost of capital goes up. So this weighted average cost of capital is used by analysts and companies themselves when they're looking at things like future investments, mergers and acquisitions, and most often it's actually used as a hurdle rate by many companies to figure out if an investment is going to be profitable. If a company has a weighted average cost of capital of 8% and there is a investment they can make that will garner 9% returns, this is at this point in time a profitable investment. But if weighted average cost of capital goes up due to rising interest rates, this can deplete that investment and actually turn it into a negative return. So as interest rates rise, overall, the cost of capital of companies goes up. So when they say it will cost more to borrow, this is primarily what they mean. And one important thing in this formula is the cost of equity. They often use something that they call the risk-free rate inside of this formula, plus an equity premium to figure out what that true cost of equity is. And they typically use the 10-year treasury. Now, if you haven't heard any sort of news about the 10-year treasury as of late, you've probably been living under a rock. It has been rising. So as it is rising, obviously the cost of equity goes up, increasing the weighted average cost of capital. So that is why rising bond yields and the rising 10-year treasury is having such an impact on high growth stocks. Overall, the higher the weighted average cost of capital, this is going to impact companies' internal decisions on what to fuel expansion with, and it's also going to impact discounted cash flow calculations and is going to somewhat taper their expectations moving forward. So now that we understand weighted average cost of capital, we know that when interest rates rise, the cost of debt goes up and the cost of equity goes up. And as a result, our weighted average cost of capital rises, making it more expensive to borrow and making future projects less profitable. And just to skip away from this for a second, the weighted average cost of capital, there is so many different debt structures within a company. Again, you will drive yourself mad trying to figure it out for the most part. Most companies will display their weighted average cost of capital in their annual and quarterly reports. Just wanted to take a quick breather from the video right now. I know this is a lot to soak in, but I just wanted to remind you to smash that like button if you're liking the video and subscribe to the channel. But most importantly, as you're going through the video, any questions you have, feel free to drop it in that comment section and also let us know what you want to see next. But let's get back to the video. But now that we have this weighted average cost of capital, how does it exactly cause valuations to drop? I mean, it does cost these tech companies more to borrow, but why are we seeing such drastic valuation resets in the tech sector? And this comes back into play with the time value of money I talked about earlier and how a dollar today is worth much more than a dollar in the future. The way you figure out what a dollar in the future is worth today is to discount it back to the present time. And one of the things that retail investors and analysts use to discount these cash flows is the weighted average cost of capital. So if you'll remember from the start of the video, I said that when we're investing, we're essentially investing now in hopes of future cash flow. So I'm going to go over a very basic example here to show you how a increased working cost of capital can actually decrease the value of that future cash flow. If we're expecting a future cash flow of, let's say, $100 10 years from now, and the current working cost of capital of that company is 5%. As of right now, the present value of that cash flow is $61.39. But let's say they go and increase interest rates, and that company's weighted cost of capital actually increases to 5.5%. We can see that the present value of that cash flow has dropped from $61 to $58.54. So that cash flow we're investing for today to be delivered in the future is now worth less. Now that interest rates have gone up, a company's future earnings as an investor today are worth less money. So now that we really understand the impacts of rising interest rates on the value of future cash flows, which again is the reason why we invest in the first place, we can now, well, at least you should understand now why somebody would be willing to pay less today for earnings in the future when those earnings are ultimately worth less. And this comes into play even more so with technology companies because they are valued much higher than a more established, slow-growing business because the promise of higher cash flow in the future is greater than the established, mature business. So as such, valuations are higher. And this is why we saw technology companies soar when interest rates dropped to some of the lowest rates we've ever seen. So this is exactly why you will see valuation resets in high-flying tech companies that are trading at, 40, 50 times earnings, and more so gravitation towards the value companies that are generating a ton of cash flow and are trading at, 10 to 15 times earnings. Because at a 40 to 50 times earnings multiple, it takes a lot of future earnings growth to make that investment profitable. And as soon as we raise interest rates, that future cash flow is worth less. So obviously in rising rate environments, investors are going to shift to companies whose future cash flows become more attractive based on their current valuation. Now, to give you a pretty quick example of how interest rates truly do impact the markets and why it's not necessarily just economic growth you need to be looking for, if we look to this chart, we can see that there was some crazy GDP growth in the United States from the 1970s to the 1980s. But if we look to the returns of the S&P 500, they actually only gained 16%. This is over a 10-year period, 16% gains. This is essentially factoring in inflation, a dead decade for stocks. If this happened today, it would be pure chaos, especially considering the returns we've been seeing over the last decade. Why did GDP grow so much, yet stock prices not budge? And that's because interest rates were insanely high during that time period. And if we span this out to the 1980s to the start of the 1990s, we can see that as long-term interest rates started dipping, the stock market started recovering, returning, over 22% a year over the next decade before returning an abysmal 16% prior to that. So everybody, I really hope this helped you understand. You've been listening to the news. You know that interest rates going up is bad for stocks. Most stocks, actually, some, financials will ultimately benefit from rising rates. But for the most part, I just wanted to lay a foundation for you to actually understand why this happens and why the tech correction right now is so swift. Now, is it overdone? Very likely. And will future interest rate rises be already baked into prices today? Yes, that's likely as well. But the fact is, valuation matters, and it has always mattered. The fact of the matter is, when interest rates go up, the future value of the cash flows that these tech companies are going to generate, if they do end up even generating any, depending on what ones you own, they're worth less today, and as such, valuations are going to be downgraded, and the overall outlook for these stocks moving forward is going to be not as bright as it was, in 2020 and 2021 when rates were so low. So everybody, I hope you liked the video. Smash that like button, head down below, subscribe, comment down below, especially with any additional questions you may have, or whether or not you even like this video. If you just want us to focus on stock research, that's fine with us. But if you want these these helpful videos, very glad to provide them. And overall, we're really happy to be back on the channel, and we're excited to bring you great content for the foreseeable future. We'll see you next time.